Hi. In this video, we're going to talk about the relatively new field of behavioral finance. Now, when I say relatively new, I don't mean in the last 6 months this has come up, but really, I think behavioral finance got started maybe in the late 1980s or thereabout. And so compared to traditional finance, it is relatively new. And it really is seen by many as a challenge to the efficient markets hypothesis. Basically, what behavioral finance is, it is the study of how psychological phenomena, how psychology affects financial behavior, decisions in households, markets, and in organizations. So while market efficiency says that everybody will react in a correct and efficient, a logical manner. Behavioral finance says that investors, that humans are prone to certain biases, that they do certain things, that their psychology is wired to do certain things a certain way. And as a result, they make mistakes. And these mistakes are predictable, and they will end up they will end up manifesting themselves in certain types of behavior. So let's take a look at this and see if we can understand some of it. Hopefully, before you're watching this video, you've already read a little bit about behavioral finance. And so I think that will help you a lot with what we're going to be talking about. But I've got a listing of behavioral finance principles that I'm going to share on the screen with you here and walk our way through. Okay, so what are some examples of behavioral finance? Well, number one is that investors tend to, and these are not in any particular order, by the way, they're not in order of importance or anything like that. Investors tend to overly rely on stereotypes. They place too much weight on conditional probabilities and not enough weight on unconditional probabilities. Well, what's conditional probability and unconditional probability? Let me give you a simple example. On average, do stocks go up or do they go down? Well, I think everybody really realizes that on average, they go up. You look at where the stock market was 20 years ago, it's up from there. Where was it 50 years ago? It's up from there. Where was it, 70 years ago? It's up from there. On average, stocks go up. That we would call an unconditional probability. In other words, not conditioned on any studying of the market or anything. If you didn't know anything about stocks at all, and you were to be asked, are stocks going to be going up or are they going to be going down? Well, based upon unconditional probability, just what happens on average, you'd have to guess that they're going to go up. That doesn't mean they go up all the time, of course, but that is what is the most likely thing to happen. Well, investors don't place much weight on what happens most often. What they do is they place a lot more weight on individual nuances. An investor is studying a particular stock and they have decided that this stock is overvalued and they are certain that its price is going to be going down. And so they will short that stock on the bet that it will go down. And it might go down, it absolutely might, but the investor will place a lot more weight on that, what we call conditional probability. In other words, the study of what it will do based upon all these details that they've been studying, rather than the unconditional probability, which just says on average they go up. So investors will tend to forget about that. Investors will tend to look at the small picture and forget about the big picture quite oftentimes, and they focus a lot more on the details rather than the main points. Number two here says that investors tend to believe that trends will continue, that whatever has happened in the recent past, investors tend to think that is what is most likely to happen going forward. So if you've seen stocks going up for the last few months, investors tend to think they'll be going up in the future, that it's not that they have gone up. They'll say they are going up, which indicates they think they're going to be going up. If stocks have gone down for the last couple of months, they're going to tend to think they're going to continue going down. Whatever has happened in the recent past, investors tend to think that trend will continue. And of course, there's not necessarily any evidence of this thing. If something's been going up for a while, there's no reason why it can't stop and turn around and go down. There's something that's been going down for a while. There's no reason it can't stop and turn back up. Number 3 example is that investors tend to be either overly optimistic or overly pessimistic. They think everything is fantastic. Everything's going to go up, up, up. The world is a fantastic place for investments. Or they think, oh no, the bottom is falling out. Everything's, the sky is falling, as Chicken Little would say, and everything's going to go terrible. Well, most of the time, okay, the best thing doesn't happen. And most of the time, the worst thing doesn't happen. Most of the time, we're kind of somewhere in the middle. But investors tend to be either overly optimistic, think that things are going to be better than what they probably will be, or they tend to be overly pessimistic, tending to think that things will be worse than what they probably will be. The next example of the intersection of psychology and finance, and we're going to see the implications of this of these things in a little bit, is that investors tend to be overconfident. Now, this is not just investors, okay? This is just people in general. People tend to think that they are better at things than they really are. Lots and lots and lots of studies on this, okay? This is just a human psychological trait, and maybe it's not necessarily a bad thing for in many ways, okay, to think you're good at things, but it's not necessarily good in terms of investing, because it has been shown if you think you are smarter than what you are, if you think you are a better investor than what you are, you tend to underestimate risk. Anyone who is and risk in terms of investing, of course, is standard deviation, possibility of loss, volatility there, that investors tend to think that they know what's going to happen. And most often don't say, gee whiz, I don't know what's going to happen. That is something investors tend to not do. And by the way, this doesn't apply just to investing. There have been interesting studies about drivers too, that drivers on average are overconfident. You ask 100 people who drive a car, 100 drivers, are they in the top 25% of all drivers? Or are they the third quartile? Are they in the second quartile? Or are they in the bottom 25% of all drivers? And only about 5% of all drivers think they're in the bottom 25%. More than 50% of all drivers think they're in the top 25%. Well, of course, by definition, only 25% are in the top 25%, and only 25% 25% are in the bottom 25%, but most people think they are better. They're better than average. Well, you can't have everybody being better than average, can you? So the same thing is true of investors. You ask 100 investors, are you a better than average investor, or are you a worse than average investor? Well, by definition, half of them are better than average, half of them are worse than average, right? It has to be. However, you're going to find probably 90% of them will say that they are a better than average investor, that investors tend to be overconfident. Next, investors base their decisions on a point of reference rather than an absolute value. By this, if we think about it in terms of, let's say, some sort of retirement savings, maybe you look at your retirement savings each quarter when your statement comes out, okay? So you say, how much is in my retirement savings? What investors do is they're not so concerned with what is the number that is in their retirement savings. They're interested in how has it changed since the last time I looked. So if the last time you looked at your retirement savings, there was $100,000 and now it's $105,000, you're feeling pretty good because it's up. But if the last time you looked, it was $100,000 and now it's $98,000 or $97,000, now you start to feel concerned, okay, maybe even panicky, because you are down, you have lost money. So it's not the dollar amount that investors are so concerned about, says behavioral finance, that it's really where you are relative to some reference point. Or if you paid $100 for a stock, most investors aren't concerned with what is the value of the stock, merely is it up from that reference point where you bought the stock, or is it down from that reference point. And what we find is that as a result of this, because they so much want to be up from the reference point and hate being down from the reference point, that investors are less willing to take risks when they find they are above their reference point. So whatever your reference point is, and it could be how much money a friend has, or where you were at some point in time, or some psychological number that you have in your mind. I needed to get $500,000 into my account. Okay, am I above it or am I below it? But if you're above that reference point, you are less likely to take risks. If you are below that mental reference point, then you are more likely to take risks. So people do not have, according to this idea, consistency in terms of their willingness to take on risks. They are more willing to take on risks if they're below their reference point, less willing if they are above that reference point. Number 6 here, humans, which of course includes investors, will often make decisions based upon the way a question is framed rather than the merits of the question. That people, psychologists know that it's not what is the question, but it's how was the question worded that can determine what is the answer to it. For example, a very famous study was done where a doctor spoke, or maybe they had it with groups of doctors. I don't know, I remember exactly what it was, but they spoke with patients, had a number of patients who all were facing elective surgery. And so they didn't have to have the surgery, but what they told the patients was this, okay, they had one group of patients, what they said was, hey, I recommend that you have this surgery. You don't have to have it, but I recommend it. I think it will improve your quality of life. And I think that would be good for you. And 98% of the people who have this surgery, they come out of it, they survive the surgery, come out of it just fine, and it improves their quality of life. Now, to another group of patients facing the same decision on the surgery, they say, hey, I recommend you have this surgery. I think it'd be a good idea to improve your quality of life, blah, 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 same thing. But I got to let you know, 2% of the people who have the surgery, they die. But I recommend that you have it, and the decision is yours whether you have the surgery done or not. So basically what was done, they gave the same information to both groups, but with one group, they said 98% survive. The other group, they said 2% die. Do you think there was a difference between those two groups in terms of how many people decided to have the surgery? Absolutely. Overwhelmingly, those who were told that 98% survive decided to have the elective surgery. Overwhelmingly, those who were told that 2% die, they decided not to have the surgery. So we see that the way a question is framed has a lot of influence on the answer. If you are told that 98% of the people survive this surgery, oh, that sounds great, I'll do it. If you're told 2% of the people who have the surgery die, you say, no, I don't want to do that. And it's both the exact same information. But the way things are framed the way questions are framed and statements are framed have a big influence on how we respond to them. Let's take a look at the next item on the list. And that is that investors tend to prefer investments with guaranteed gains. You may say, well, of course, we tend to prefer investments with guaranteed gains. But if you see one investment has a 99% probability of a gain, and another one has a 100% probability of a gain, that last 1% has a big impact, okay? Bigger impact than, say, going from 25% to 26% or 17% to 18%. Investors tend to gravitate towards certain gains, guaranteed gains. They also tend to gravitate away from guaranteed losses. If something has a 99% chance of you losing money, that's much better in the eyes of investments than having a 100% chance of losing money, because at least there's some possibility that I won't lose the money there. Okay, 90% chance of a loss isn't good, but 100% chance of a loss is something we will try to recheck. So investors will gravitate towards sure gains, and they will gravitate away from sure losses. And this can distort the way you tend to evaluate investments, because you would maybe rather have a sure gain that is a small gain rather than the possibility of a much larger gain, which is not so much of a sure thing. Then number 9 here we've got on the list is that investors tend to look at separate investments individually rather than as part of a portfolio. Portfolios are looking at the whole picture, okay? Investors tend to look at, okay, here is some money that I've got invested for retirement, and here is some money that I've got invested for my kids' college education. Here's some money that I've got invested for my vacation next year. And they don't look at the whole picture, okay? And they manage them differently. Now, money is fungible, okay, which means you don't need to have them all invested differently, okay? You need to look at the whole portfolio. Now, this is something that once I saw this, I realized, man, I'm really guilty of this. I tend to do that sort of a thing. I tend to look at investments into different buckets, into different pockets of money, and maybe would take different investment strategies with them rather than saying, hey, what is the entire portfolio that I have here? Okay, well, what are some of the implications of these behaviors that psychiatrists and those in behavioral finance have found in investors? Number 1 is that investors will tend to sell winners too soon. And number 2 goes right along with it, that investors will tend to hold on to losers too long. This is called the disposition effect. And I think I can illustrate this best with a diagram. So let me go to the whiteboard here, okay? And we'll show you what we're talking about. One of the things we learned earlier in this course is we saw that investors were risk averse. And we said that one of the reasons why, one of the proofs that investors were risk averse were that if this is your level of wealth over here, and this is your utility of wealth over there, how much enjoyment you get from the wealth, how much good feeling you get from it. We said that, hey, as you get more wealth, you tend to get more utility, okay? That you prefer more wealth to less wealth. But that as you get more and more wealth, that additional utility starts to tail off. We said that Bill Gates or Warren Buffett or Jeff Bezos or Elon Musk, somebody who's very, very wealthy, if they get an additional $10,000, they like it, but it's not that big of a deal to them. Whereas if someone is homeless, okay, or they're just a poor, struggling college student, they get $10,000, that's a huge deal to them. So as a result, we've got a concave curve like this, right? That everybody likes to get more wealth, but the homeless person here gets a lot of utility from that wealth, whereas Bill Gates gets a little bit of utility from that same additional wealth. Okay, so that led us to the conclusion that investors are risk averse. Well, what behavioral finance is saying now is that, wait a second, that's not the way we should look at it. The way we should look at it is with regard to a reference point. That really, this point right there is now going to be our reference point, and we're going to go this way. And we're going to say, this is where your starting point was. Let's just say, make it really simple. You buy a stock for $100, okay? That what is of interest to the person, what the person cares about is not what is the price of the stock. It's what is the price of the stock relative to what I paid for it at $100. So if this is the $100 you paid for it, then we're going to have a curve that inflects right here, and it's going to go down like this. that so this is when the stock has gone up, right? Your level of wealth has gone up. The stock has gone up to 101, 102, 103. And then indeed investors are risk averse, okay, at situation. But that in fact, investors are risk loving with the stock has gone down to 99, 98, 97, so forth. That when the stock has gone down in value, they are getting desperate, okay? They're getting nervous, okay? They're starting to perspire, that they're concerned with, wow, this went down. What do I need to do to be able to get it back up there? And they will take on more risk. That's called the disposition effect. It says investors are not purely risk averse, okay? What it is that they're risk averse when it comes to gains, and they're more risk loving when it comes to losses. If you start, let's make it a bigger number. If you have $100,000 in your in your retirement account, and here it is middle of December, and you see it's gone up, or you had $100,000 at the beginning of the year. Here it is the end of the year, and middle of December, and it's gone up to 110,000, 120,000. You're feeling pretty good, and you want to hold on to those gains. You're very risk averse. That you want to lock them in. But if it's gone down to 95 or 94,000, you're saying, oh my gosh, I can't have at the end of the year less money than I had at the start. So therefore, I need to take some more risky actions to try to get myself back up to that $100,000. So that investors are not looking at the level of wealth, but the level of wealth relative to where you started. That's called the disposition effect. Now, how does this manifest itself in terms of selling winners too soon and holding on to losers too long? Well, let's go back to our stock that you bought for $100. Okay, if its price today is $110, okay, investors are more likely to sell that stock because they can lock in the gain. They can pat themselves in the back and say, my, what a smart investor I am. So they will tend to sell that too soon if you want it to be. Okay, I mean, whether it turns out to be too soon or not, doesn't matter. I don't know. But the point is that investors are more willing to sell stocks that have gone up. But let's suppose that $100 stock that you paid for it is now down to $90. Well, investors don't want to sell it. And the reason why is because if they sell it, they have to admit they made a mistake, that they lost money on the stock. They're locking in their loss, and nobody wants to admit that they made a mistake, not even to themselves. So what they do is they tend to hold on to it. Why? In the hopes that it'll go back up to 100, and then they don't have to admit that they were wrong. They just, they were right, but they were just a little bit too early with the decision as to when to buy it. So studies have shown that stocks that have gone up from the purchase price, investors are more willing to sell. Stocks that have gone down, investors are less likely to sell. They're more willing to hold on to it. Actually, it shouldn't matter what you paid for it. The question is, where is the stock going to go from here? If you think the stock is going to go up, you should hold on to it. If you think the stock is going to go down, you should sell it. So if it's sitting at 100, the question is it going to go here? Okay. Or is it going to go there? If it's sitting at 90, is it going to go up or is it going to go down? But really the most important thing to many investors is not what is its value now, but has it gone up from where I bought it? Has it gone down from where I bought it? Did I make a gain or have I made a loss? And if it's gone down, I don't want to sell it. I got to try to let it get back up again. If it's made a gain, then I can sell it, because then I can say how smart I am having made that gain there. So let's go back to the list here, and let's see what the next item is. Okay, that investors, well, I've already mentioned this here. Investors will invest in riskier stocks if the investor is down for the year, and investors will invest in safer stock if the investor is up for the year. Okay, and think about it, is that true with you? Okay, if you've made a bunch of money already this year, are you more likely to say, well, I better lock that in? Okay, or if you've lost some money in your investments this year, are you saying, man, I better get in some more risky investments so that I can make that back up? Number 5, the market will be more volatile than the economy. Now, ultimately, the market is a representation of the economy. The stock market is ownership of companies that are in the economy. So ultimately, how the economy does should be how the stock market does, right? If the economy is up, the stock market should be up. If the economy is down, the stock market should be down. Now, the timing may not be the same. The stock market is kind of a leading indicator. It indicates what people think is going to be happening to the economy. But on average, they should be doing about the same. However, what actually happens is that the market is much more volatile than the economy. The economy's got some ups and downs like this, but the market has got ups and downs like this. Well, why is the market much more volatile than the economy? Well, those in behavioral finance will say it's based upon this number 3 here, that investors tend to be either overly optimistic or overly pessimistic. So if investors think the economy is great or the economy is terrible, they're going to be more likely to do more buying or more selling than is warranted. So this is a truth, by the way, that there have been lots of studies on this, that the market is more volatile than the economy. What else is implied here? That investors will short stocks too often? Well, heck, if stocks go up, the last statistic I heard was that stocks go up about 65 to 70% of the time. Okay, then 65 to 70% of the time, you're going to be wrong if you short the stock. Now, that means you could be right, certainly. Okay, but investors who do not look at unconditional probabilities will tend to ignore that. 65 to 70% of the time stocks are up, and there'll be more shorting goes on than should be. Investors will under diversify if they think that they're right. I mean, why should I diversify if I'm so smart and I know what is the best stock? If I know the stock is going to go up, then heck, I should just put all my money into that stock. Why would I diversify? Okay. Well, the reason why is you might not be right. Okay. But people who are overly confident, okay, aren't going to say, I might be wrong. Even if you've been wrong in the past, people are not going to admit that they might be wrong, and then they're going to be under diversified. Number 8, investors will hold very risky and very safe investments in the same portfolio. Well, why would you do that? Okay, you got something very risky here. That's not for diversification purposes. It's because they think this money is speculative play money over here, and this money over here, oh, that's for my kid's college education. Okay, I can't play around with that. And they don't look at the entire portfolio. So they may have very safe investments here and very risky investments over there. And again, not thinking about the fact that money is fungible. If you lose $1,000, does it really matter which bucket it comes from? Because you can move, unless we're talking about tax deferred accounts versus taxable accounts. Unless we're talking about that, you can move money from one. If you lose $1,000 over in this bucket, just move 1,000 from that bucket. So it doesn't really matter which bucket it is in. Okay, the only one that's keeping you from moving it from one bucket to another is you. And then finally, investors tend to follow the herd. Investors are very concerned, okay, that, hey, I might be wrong. It hurts more to be wrong than it feels good to be right. The biggest concern of an investor is that everybody else will be right and I'm wrong. Okay, that's more of a concern than being wrong. If everybody is wrong and I'm wrong along with everybody, it doesn't make me feel so bad. But if everybody else is right and I'm wrong, oh no, that just makes me feel terrible. Again, that's the psychology that's in there. Okay, really, numbers wise, it doesn't matter what everybody else is doing. What matters, were you right or were you wrong? So investors tend to follow the herd. They tend to do what everybody else is doing simply because they don't want to be wrong with everybody else right. That is a worse feeling than the good feeling from being right when everybody else was wrong. So they tend to not to step out on their own. So anyway, it's a fascinating field, okay? But none of this is contained in your traditional modern portfolio theory. Modern portfolio theory says investors are rational, they're risk averse, they will go. They are expected utility maximizers. They base their decision upon what's going to give me the highest expected level of utility based upon expected returns and standard deviations. And this is saying, nah, there's a lot of psychology that goes in there, and that investors are not necessarily so rational. And that if you know what are the tendencies, okay, of investors, you can compensate for that, hopefully, and maybe you can even make a little bit of money off of what everybody else is doing. But that's hard to do because we all have these biases that are in us. So anyway, I hope you'll study this field a little bit more. It's fascinating. There's a lot of writing on it, but it's called behavioral finance, and it is the intersection of psychology and finance.